Right now, at this very moment, something unprecedented is happening in the copper market that almost nobody's talking about. Major bullion dealers across the United States are hanging up sold-out signs. Physical copper bars and rounds that you could easily buy just 6 months ago have completely vanished from inventory. And here is the part that should send chills down your spine. When you call these dealers and ask when they expect new stock, they cannot give you an answer. They simply do not know. What we are witnessing right now is not a temporary glitch. This is the beginning of a supply crisis that could reshape entire industries and make copper one of the most valuable metals on the planet. Welcome to PriceDiscoveryDesk, where we break down the real stories behind commodity markets that mainstream financial media refuses to cover. If you find value in this deep dive into the copper crisis, do me a quick favor and hit that like button right now. It helps this video reach more people who need to understand what is happening. And if you are not subscribed yet, click that subscribe button and turn on notifications so you never miss our weekly market analysis. Trust me, you are going to want to stay informed as this copper situation unfolds over the coming months. Now let me take you inside this story from the beginning, because understanding how we got here is essential to understanding where we are headed. Copper has always been called Dr. Copper by economists and traders because it has this uncanny ability to predict economic health. When copper demand rises, it usually signals that construction, manufacturing, and infrastructure are growing. When copper falls, it often warns of economic slowdown ahead. But what is happening now breaks all the traditional models that analysts have relied upon for decades. You see, we're in a situation where economic uncertainty is rising. Yet copper demand is not just stable, it is absolutely exploding. The reason comes down to three massive megatrends happening simultaneously. First, we have the global push toward electric vehicles. Second, we have the renewable energy revolution requiring massive amounts of copper for solar panels, wind turbines, and grid infrastructure. And third, we have the artificial intelligence boom creating unprecedented demand for data centers that require enormous amounts of copper wiring and electrical components. Each of these trends alone would stress the copper supply chain. Together, they are creating a perfect storm that the market simply was not prepared to handle. Let me give you some numbers that will put this into perspective. A traditional gasoline-powered car uses about 40 to 50 pounds of copper. An electric vehicle uses roughly 3 to 4 times that amount, somewhere between 170 and 200 pounds of copper per vehicle. Now consider that automakers worldwide have committed to producing tens of millions of electric vehicles annually within the next decade. Where is all that copper going to come from? The mines that currently exist cannot possibly produce enough. And here is the kicker. New copper mines take anywhere from 15 to 20 years to develop from initial discovery to full production. We are facing a demand surge right now, and the supply response is literally a decade or more away. This fundamental disconnect between supply and demand is what is causing dealers to run out of physical copper. And it is not just happening in one region or with one dealer. Reports are coming in from across the country. Major online bullion retailers that typically have thousands of copper products in stock are showing zero availability. Local coin shops that always kept copper rounds in their display cases are telling customers they cannot get inventory from their suppliers. Even wholesale distributors who supply the retail dealers are struggling to source physical copper in the quantities they need. I want to share some real examples of what is happening on the ground, because I think hearing specific stories makes this crisis more tangible and real. One major online dealer that I have been tracking typically maintains inventory of at least 50 different copper products, everything from 1-ounce rounds to 10-pound bars. As of this recording, they have exactly 3 copper products available, and those are showing limited quantities. When you try to add more than 5 or 10 pieces to your cart, you get an error message saying the quantity requested is not available. Another dealer that I spoke with told me something fascinating. He said that his supplier used to deliver copper products within 3 to 5 business days of placing an order. Now the supplier is quoting 6 to 8 weeks delivery time, and even those estimates come with no guarantee. The supplier honestly cannot promise that copper will be available even 2 months from now. That is how tight this market has become. But here is what really caught my attention. This dealer told me that customer demand for copper has increased dramatically over the past 3 months. People who never showed interest in copper before are suddenly calling and asking to buy large quantities. Some of these buyers are retail investors who see what is happening with electric vehicles and renewable energy and want exposure to copper. Others are small business owners who use copper in their operations and are trying to stockpile inventory before prices rise further. And still others are preppers and survivalists who see copper as a useful bartering metal in emergency scenarios. All of this demand is hitting at exactly the wrong time because the supply side of the equation is facing serious challenges. Let me walk you through what is happening with copper mining around the world, because this is crucial to understanding why physical copper is becoming so hard to find. The largest copper-producing countries in the world are Chile, Peru, China, the Democratic Republic of Congo, and the United States. Together, these 5 nations account for approximately 60% of global copper mine production. And right now, every single one of them is facing obstacles that are limiting their output. Chile is the world's largest copper producer by a significant margin, responsible for roughly a quarter of global production. But Chile's copper industry is dealing with a perfect storm of problems. Water scarcity in the Atacama Desert, where most Chilean copper mines are located, is reaching critical levels. Copper mining is extremely water intensive, and as the climate changes and droughts become more frequent, mines are struggling to secure the water they need for operations. Some mines have had to reduce production specifically because they cannot get enough water. Beyond the water issue, Chile's copper industry is dealing with declining ore grades. This is a problem that does not get enough attention, but is absolutely critical to understanding the supply crunch. When miners first developed the major Chilean copper deposits decades ago, the ore they extracted contained relatively high concentrations of copper, sometimes 2% or more. Today, the average ore grade at Chilean mines has dropped to around 0.5% or less. This means miners have to move and process roughly 4 times as much rock and dirt to extract the same amount of copper. That dramatically increases costs, energy consumption, and time required to produce each ton of copper. Peru, the world's second largest copper producer, has faced repeated disruptions from community protests and political instability. Local communities near mines have increasingly pushed back against mining operations, citing environmental concerns, water contamination fears, and inadequate sharing of mining wealth with local populations. These protests have repeatedly forced mines to suspend operations, sometimes for weeks or months at a time. The political situation in Peru has also been unstable, with multiple changes in government creating uncertainty about mining regulations and taxation that makes companies hesitant to invest in expanding production. In the Democratic Republic of Congo, which has become an increasingly important copper producer in recent years, the challenges are different but equally serious. Infrastructure limitations, political instability, and governance issues make it difficult to ramp up production quickly. Getting copper out of remote mining areas to ports for export requires navigating roads and railways that are often in poor condition. And concerns about child labor and human rights abuses in some mining operations have led some buyers to avoid Congolese copper entirely, further tightening supply in legitimate markets. Even in the United States, which was once a dominant force in global copper production, mining output has been relatively flat for years. Strict environmental regulations, lengthy permitting processes, and local opposition to new mines have made it extremely difficult to bring new production online. There are copper deposits in the United States that have been known about for decades, but remain undeveloped because of regulatory and political obstacles. The Resolution Copper project in Arizona, which could become one of the largest copper mines in North America, has been in development limbo for years due to environmental reviews and opposition from Native American groups who consider the site sacred. So on the supply side, we have mines dealing with water shortages, declining ore grades, community opposition, political instability, infrastructure limitations, and regulatory obstacles. None of these problems have quick solutions. And remember, even if companies decided today to fast-track new mine development, we are looking at 15 to 20 years before significant new production comes online. The copper shortage we are experiencing now will likely get worse before it gets better. Now let me shift to the demand side of the equation, because what is happening there is equally remarkable. I mentioned earlier the 3 megatrends driving copper demand, but I want to go deeper into each one so you fully understand the magnitude of what is coming. The electric vehicle revolution is probably the most discussed driver of copper demand, and for good reason. Every major automaker on the planet has announced plans to electrify their vehicle lineups. General Motors has committed to selling only zero-emission vehicles by 2035. Ford is investing $50 billion in electric vehicle production. Volkswagen, the world's largest automaker by volume, is aiming for 70% of its European sales to be electric by 2030. These are not vague aspirations. These are concrete business plans with billions of dollars of capital investment behind them. But here is what most people miss about electric vehicle copper demand. It is not just the cars themselves that need copper. The entire charging infrastructure requires enormous amounts of copper as well. Home charging stations, public fast chargers, the electrical grid upgrades needed to handle the additional load. All of this requires copper. Some analysts estimate that the charging infrastructure alone could require more copper than the vehicles themselves by the time we reach widespread electric vehicle adoption. And electric vehicles are just one part of the broader electrification trend. Buses, trucks, delivery vans, construction equipment, and even aircraft are being electrified. Each of these applications requires copper for motors, wiring, and charging systems. The transportation sector's demand for copper is going to increase by multiples over the coming decades. The supply simply is not there to meet it. The renewable energy transition is the second megatrend, creating unprecedented copper demand. Solar power, which has become the cheapest form of new electricity generation in most parts of the world, is incredibly copper intensive. A typical solar installation uses approximately 5 tons of copper per megawatt of generating capacity. That includes copper for the solar panels themselves, the inverters that convert direct current to alternating current, the wiring that connects panels to the grid and the transformers and substations needed to integrate solar power into the broader electrical system. Wind power is even more copper intensive than solar. Offshore wind turbines, which are becoming increasingly common, can use up to 15 tons of copper each. The cables that carry electricity from offshore wind farms back to shore are massive copper conductors that can stretch for miles under the ocean. As countries around the world race to build out wind generation capacity, the demand for copper is skyrocketing. And then there's the electrical grid itself, which needs massive upgrades to handle all this new renewable generation. The existing grid was designed for a world where large centralized power plants generated electricity that flowed one way to consumers. The renewable energy grid of the future is fundamentally different, with millions of distributed generation sources like rooftop solar panels feeding power back into the system. This requires a complete rethinking of grid architecture and enormous amounts of new copper wire and electrical equipment. The third megatrend, which has exploded into prominence just in the past year or two, is artificial intelligence and the data centers required to power it. If you have used ChatGPT or any of the other AI tools that have become suddenly ubiquitous, you have benefited from massive data centers humming away somewhere, consuming enormous amounts of electricity and copper. The AI boom has triggered an unprecedented wave of data center construction. Microsoft, Google, Amazon, Meta, and dozens of smaller players are racing to build out the computing infrastructure needed to train and run AI models. Each new data center is essentially a giant warehouse full of servers, all of which need copper for power distribution, networking cables, cooling systems, and more. Some estimates suggest that a large hyperscale data center can contain over 1 million pounds of copper. And the AI arms race is just beginning. The computing power required for cutting-edge AI models is doubling roughly every 6 months. Each new generation of models requires more powerful hardware, more data centers, and more copper. There is no end in sight to this demand growth. If anything, it is accelerating as AI moves from experimental technology to critical business infrastructure. I want to take a moment here to address something that I know some viewers might be thinking. With all this demand for copper, why is not everyone talking about this shortage? Why is this not front-page news on every financial website? The answer partly comes down to how commodity markets work and who controls the narrative. The copper market is dominated by large institutional players, mining companies, industrial users, and commodity traders who have strong incentives to downplay supply concerns. Mining companies do not want to admit that they cannot ramp up production fast enough because it makes them look poorly managed. Industrial users do not want to spark panic buying that would drive prices even higher. And traders often profit from volatility and information asymmetry, so they have no reason to broadcast what they know to the general public. There is also a disconnect between the paper copper market and the physical copper market that I think is really important to understand. When most people talk about copper prices, they are referring to futures contracts traded on exchanges like the COMEX in New York or the London Metal Exchange. These are paper contracts that represent promises to deliver copper at some future date. The vast majority of these contracts are settled in cash, not with physical metal delivery. The paper market can operate somewhat independently of physical supply and demand for extended periods because most participants are not actually seeking to obtain copper. They are speculating on price movements or hedging other positions. This means the paper price of copper does not always accurately reflect the true scarcity of physical metal. What we are seeing now with dealers selling out of physical copper is a real-world signal that the paper market price may not be telling the whole story. When you cannot actually buy physical copper at any price, the quoted exchange price becomes somewhat meaningless. This disconnect between paper and physical markets has happened before with other commodities, notably with silver during various supply crunches, and it often precedes dramatic price adjustments when the paper market is finally forced to acknowledge physical reality. Let me talk about what all of this means for prices going forward, because I know that is what many of you are wondering. Copper prices have already risen substantially over the past few years, reaching all-time highs on multiple occasions. As I record this, copper is trading near historic highs, and many analysts expect further gains ahead. But here is what I think is really important to understand. The current price, as high as it seems, may not yet reflect the true extent of the supply shortage that is developing. Prices in commodity markets are forward-looking, but they are also influenced by near-term supply and demand dynamics. The multi-year structural shortage that is building in copper has not fully registered in prices yet because the most acute phase of the shortage is still ahead of us. Consider this thought experiment. If we know with near certainty that electric vehicle production is going to require millions of additional tons of copper annually by 2030, and we know that new mine supply cannot possibly keep up, what should the price of copper be today? In a truly efficient market, prices would already reflect that future scarcity. But commodity markets are not always efficient, especially when the scarcity is several years away and most participants are focused on near-term factors. I believe we are in the early stages of a repricing of copper that could take the metal to levels that seem unthinkable today. Some analysts have begun floating price targets of $15, $20, or even $30 per pound for copper in the coming years. These numbers sound extreme when copper has historically traded between $2 and $5 per pound. But when you consider the magnitude of the supply-demand imbalance that is building, extreme prices may be exactly what is required to balance the market. High prices serve an important function in commodity markets. They incentivize new supply by making marginal projects economically viable. They also curtail demand by forcing users to find substitutes or reduce consumption. If copper truly becomes scarce, prices will have to rise to whatever level is necessary to bring supply and demand back into balance. Given the difficulty of bringing new supply online quickly and the relatively inelastic nature of demand from electric vehicles and renewable energy, that balancing price could be very high indeed. Now I want to address the question of substitution because I know some of you are thinking about it. When a commodity becomes expensive, users typically look for cheaper alternatives. Could copper be replaced by other materials, thereby alleviating the shortage and capping prices? The short answer is that copper is extremely difficult to substitute in most of its major applications. Copper's unique combination of properties, including excellent electrical conductivity, thermal conductivity, corrosion resistance, malleability, and ability to form alloys, makes it nearly irreplaceable for many uses. Aluminum is sometimes mentioned as a potential copper substitute. And it is true that aluminum is used in some electrical applications, like power transmission lines. But aluminum has only about 60% of copper's electrical conductivity, which means you need more aluminum to carry the same electrical current. Aluminum is also more prone to corrosion and creates connection problems when joined to other metals. For applications like electric vehicle motors, high-performance electronics, and data center wiring, aluminum is simply not a viable substitute for copper. Silver is actually a better electrical conductor than copper, but it is far too expensive for most applications and much scarcer than copper. Using silver to replace copper would be like using gold to replace steel. It just does not make economic sense. Fiber optics have replaced copper in some telecommunications applications, and this is one area where copper demand has genuinely declined. But fiber optics cannot carry electrical power, only data signals. For all the applications that require conducting electricity, which is the vast majority of copper usage, there is no fiber optic substitute. The bottom line is that for the applications driving the current demand surge, electric vehicles, renewable energy, and data centers, there are no practical substitutes for copper at any reasonable price level. This means demand is relatively price inelastic, and even substantially higher prices will not significantly reduce the amount of copper these industries need. I also want to discuss what is happening with copper inventories, because this is another critical piece of the puzzle. Exchange warehouses, where copper is stored for delivery against futures contracts, have seen inventory levels drop dramatically over the past couple of years. London Metal Exchange copper inventories have fallen to levels that represent only a few days of global consumption. COMEX inventories have also declined sharply. When inventories are this low, even small disruptions in supply or spikes in demand can cause dramatic price moves. There is simply no buffer in the system. The copper market is operating on a just-in-time basis, with virtually no margin for error. Any unexpected mine closure, shipping disruption, or surge in buying could trigger a price spike of historic proportions. This is exactly the environment that creates the kind of physical shortages we are seeing at the dealer level. When large industrial users start worrying about whether they can get the copper they need, they begin hoarding and ordering extra inventory as a precaution. This hoarding behavior, which is completely rational from each individual buyer's perspective, makes the shortage worse for everyone else. It is a self-reinforcing cycle that can quickly drain available supplies. There are reports that some large industrial consumers are now signing long-term supply contracts directly with mining companies, bypassing the spot market entirely. They are willing to pay premium prices to lock in guaranteed supply because the risk of not having copper when they need it is simply too great. This behavior further tightens the physical market and leaves less copper available for everyone else. Let me shift now to talking about what this all means for investors and people trying to protect their wealth, because I know that is a major interest for many viewers of this channel. Copper presents an interesting opportunity, but also some unique challenges compared to precious metals like gold and silver. On the opportunity side, copper appears to be in the early stages of a structural bull market driven by megatrends that will unfold over years and decades. Unlike speculative bubbles that can pop at any moment, the demand drivers for copper are real tangible, and backed by trillions of dollars of committed capital investment. Electric vehicles, renewable energy, and AI data centers are not going away. If anything, these trends are accelerating. The supply constraints facing copper are also not going to be resolved quickly. New mines take 15 to 20 years to develop. Ore grades at existing mines continue to decline. Water scarcity, community opposition, and regulatory hurdles show no signs of easing. The supply side of the copper market faces persistent structural headwinds that will keep production growth limited for the foreseeable future. All of this suggests that copper prices have substantial room to rise over the coming years. Investors who gain exposure to copper now could benefit significantly as the supply-demand imbalance becomes more acute. However, there are challenges to investing in physical copper that do not apply to gold or silver. Copper is much less valuable by weight than precious metals, which means storing significant value in physical copper requires dealing with large, heavy quantities of metal. $100,000 worth of gold fits in the palm of your hand. $100,000 worth of copper would weigh several tons and require a truck to transport. This is why most physical copper available to retail investors comes in the form of small bars or rounds that carry substantial premiums over the melt value of the metal. You might pay 50% or more above spot price for a copper round from a bullion dealer. This premium makes copper less attractive as a pure investment vehicle compared to gold or silver, where premiums are typically much lower. However, if the physical copper shortage continues to intensify and dealer supplies remain limited, even those premiums could look reasonable in hindsight. When you cannot buy something at any price, what you paid yesterday starts to seem like a bargain. For investors who want copper exposure without dealing with physical metal, there are other options. Copper mining stocks offer leveraged exposure to copper prices because their profits expand rapidly when prices rise. However, mining stocks also carry company-specific risks related to management, mine development, political exposure, and operational issues. Copper-focused exchange-traded funds provide more diversified exposure to the copper market. Some ETFs hold physical copper, though these are less common than gold or silver ETFs. Others track copper futures prices, which introduces the complexities of futures roll costs and contango that can erode returns over time. Each of these approaches has pros and cons, and the right choice depends on your individual circumstances, risk tolerance, and investment timeline. What I would encourage everyone to do is to educate yourself about the copper market and think seriously about whether some allocation to copper makes sense in your portfolio given the structural trends I have outlined. Here at PriceDiscoveryDesk, our mission is to help you understand what is really happening in commodity markets so you can make informed decisions. We do not give personalized investment advice, but we do try to present information and analysis that you will not find in mainstream financial media. The copper story we are covering today is a perfect example. This is a massive developing situation with enormous implications, yet it receives almost no attention from major financial news outlets. Let me spend some time now talking about the geopolitical dimensions of the copper shortage because this is another angle that does not get enough attention. Copper is not just an industrial commodity, it is increasingly a strategic resource with national security implications. Think about what copper enables: electric vehicles that reduce dependence on foreign oil, renewable energy that provides energy independence, data centers that power the AI systems, increasingly central to military and intelligence operations, advanced weapon systems that require copper for electronics and electrical components. A nation that cannot secure reliable copper supplies is at a strategic disadvantage in the 21st century. This reality is not lost on major powers. China has been particularly aggressive in securing copper resources around the world. Chinese companies have made major investments in copper mines in Africa, South America, and Southeast Asia. China has also been building substantial domestic stockpiles of copper, anticipating future supply constraints. The United States has been slower to recognize copper as a strategic resource, but this is beginning to change. There is growing bipartisan recognition that critical mineral supply chains, including copper, represent a vulnerability that needs to be addressed. Some proposed legislation would provide incentives for domestic copper mining and processing, though progress has been slow given environmental concerns and local opposition to new mines. The competition for copper resources could become a source of international tension in the coming years. Countries that have copper deposits are gaining geopolitical leverage. Countries that depend on copper imports are facing strategic vulnerability. This adds another layer of complexity to the copper supply picture and could create additional disruptions that the market is not currently pricing in. I want to share some perspective on historical precedents for what we are seeing in the copper market, because I think history provides useful context for understanding where this could go. In the 1970s, the world experienced severe shortages of various commodities driven by a combination of demand growth, supply disruptions, and geopolitical factors. Oil is the most famous example, with prices quadrupling during the Arab oil embargo. But other commodities experienced even more dramatic price moves during this period, and supply shortages became common across many materials. The conditions today share some similarities with the 1970s. We have strong demand growth from structural factors that are difficult to reverse. We have supply constraints that cannot be quickly resolved. We have geopolitical tensions that could disrupt trade flows. And we have monetary policies that have created inflation in the broader economy. During the 1970s, investors who held commodities and commodity-linked assets significantly outperformed those who held traditional financial assets like stocks and bonds. Commodities provided protection against inflation and benefited from supply-demand imbalances that took years to resolve. I am not predicting that the 2020s will be an exact replay of the 1970s. History does not repeat exactly, though it often rhymes. But I do think we are in an environment where commodity supply constraints could produce surprising outcomes. The decades of commodity abundance that we experienced after the 1980s may be giving way to a new period of scarcity and higher prices. Let me address some of the skeptical arguments I have heard about the copper shortage thesis, because I think it is important to consider opposing viewpoints. Some skeptics argue that technology will solve the copper supply problem. New mining techniques could extract copper from lower grade ores more efficiently. Recycling could provide an increasing share of copper supply. These are valid points, and I do expect technology to help at the margins. But the scale of the demand increase we are facing is so large that incremental improvements in mining efficiency or recycling rates will not be sufficient to close the gap. Recycling in particular is often cited as a solution, but copper recycling has limitations that people often overlook. Copper can be recycled multiple times without losing its properties, which is great, but recycling only provides supply to the extent that copper products reach end of life and enter the scrap stream. Most of the copper demand growth we are discussing is for new applications, not replacement of existing copper products. Electric vehicles being manufactured today will not be recycled for 15 or 20 years. The copper going into new data centers and renewable energy installations will be in use for decades before it becomes available for recycling. Other skeptics point to potential demand destruction if copper prices rise too high. At some price level, they argue, industrial users will be forced to reduce consumption or find alternatives. This is economically correct in principle. But, as I discussed earlier, the main demand drivers for copper have very limited substitution possibilities. You cannot build an electric vehicle or a wind turbine without copper, regardless of price. The demand is relatively inelastic, which means prices have to rise very high before demand is meaningfully affected. Finally, some skeptics argue that high prices will incentivize new supply that will eventually bring the market back into balance. This is also true in principle, and I expect it to happen eventually. But eventually could be a decade or more away. New copper mines are not built quickly. The supply response to high prices is measured in years and decades, not months. In the meantime, the market could experience severe shortages and dramatic price spikes. I believe the balance of evidence strongly supports the thesis that copper is in a structural supply deficit that will persist for years and likely intensify before it improves. The physical copper shortage at the dealer level that we are seeing today is an early warning sign of what is coming. Those who pay attention to this signal now will be better positioned than those who wait until the shortage becomes impossible to ignore. As we approach the end of this deep dive into the copper market, I want to summarize the key takeaways and leave you with some thoughts about what to watch going forward. First, the physical copper shortage at dealers is real and appears to be intensifying. Multiple reports from dealers across the country confirm that inventory is extremely low and resupply is uncertain. This is not a temporary glitch, but rather a symptom of deeper supply constraints. Second, the supply side of the copper market faces severe structural challenges. Declining ore grades, water scarcity, community opposition, political instability, and long development timelines for new mines mean that supply growth will be limited for the foreseeable future. Third, demand for copper is being driven by three powerful megatrends that show no signs of slowing. Electric vehicles, renewable energy, and AI data centers are all requiring unprecedented amounts of copper, and this demand will continue growing for decades. Fourth, the current price of copper may not fully reflect the magnitude of the shortage that is developing. There is potential for significant price increases as the market confronts the reality that supply cannot keep up with demand. Fifth, copper is increasingly becoming a strategic resource with geopolitical implications. Competition for copper supplies could create additional disruptions and tensions. Going forward, there are several things I would encourage you to watch as indicators of how the copper situation is evolving. Monitor copper inventory levels at major exchanges like the LME and COMEX. Watch for news about mine disruptions, production cuts, or project delays. Pay attention to reports about physical copper availability at dealers and industrial suppliers, and follow developments in electric vehicle sales, renewable energy installations, and data center construction as indicators of demand growth. If you found this analysis valuable and want to stay informed about developments in the copper market and other commodities, make sure you are subscribed to Price Discovery Desk and have notifications turned on. We will continue to track this story as it unfolds. Before I wrap up, I want to ask for your help in spreading the word about what is happening in the copper market. If you found this video informative, please take a moment to share it with someone who you think would benefit from this information. Send the link to a friend who invests in commodities, post it to your social media, or mention it in investment forums you participate in. The more people who understand what is happening with copper, the better prepared our community will be for what is coming. I would also love to hear your thoughts and perspectives in the comments section below. Have you experienced difficulty buying physical copper? What do you think about the thesis that copper is entering a structural shortage? Do you have exposure to copper in your portfolio? Share your thoughts and let us start a conversation. I read all the comments and try to respond to as many as I can. Your engagement helps the algorithm recommend this video to more people who would find it valuable. This is what we do here at Price Discovery Desk, bringing you the real stories about commodity markets that mainstream media overlooks. The copper shortage is just one example of the kind of supply crunch that could reshape the investment landscape in the years ahead. Understanding these dynamics before they become front-page news gives you a tremendous advantage. Thank you for spending this time with me today. I genuinely appreciate your attention and trust that you will put this information to good use. Stay curious, stay informed, and I will see you in the next video. Take care.